Hello, welcome to Salaried Individual channel. Today we'll talk about 5 reasons why ETFs might not be a good investment. So first we'll talk about what exactly is an ETF. An ETF or an exchange traded funds are one of the best and easiest way to invest in the market. Stock market actually. ETFs are collection of stocks, or we can say a basket of stocks, and thus it lets you invest in a large number of stocks at once. Think about ETF as a basket of stock. So if I have to create an ETF of top 10 stocks by market cap, so what it will have? It will have stocks like TCS, Reliance, HDFC, etc. Because I am creating I'm creating a basket of only top 10 stocks, and that's what an ETF is all about. So that's why ETFs provides investors an easy and convenient way to gain exposure to variety of asset class. But like any other investment, ETFs also comes with risk, which investors should be aware of, so that they can evaluate if the ETFs are for them or not based on their investment goals and risk tolerance. So in this video, we'll go through the 5 reasons why ETFs might not be a good investment for you. Number 1 reason why ETF is not a good investment is that it has limited liquidity. First and foremost reason for not investing in ETF is because of its limited liquidity. If you are investing small amount, then liquidity is actually not a problem. Liquidity becomes a problem when the investment amount is quite high. Okay, so what does liquidity means? Liquidity means difficulty while buying or selling the ETF shares. This happens for most of the ETFs because of the low trading volumes in the market. And thus, because of that, the cost of trading increases as it gets harder to execute the large orders at your desired price. Say for example, you have to sell 1 lakh shares of an ETF and you don't have a buyer. What you will do? You will lower your price, and that increases your cost of trading. Along with that, the low liquidity can fluctuate the prices and thus makes it more expensive to buy. Say for example, you have to buy 1 lakh shares of an ETF, but since it's a volatility, you are not finding any seller for that actual price. So what you have to do? You have to increase your buy price, and thus it will become more expensive. So it's always better to be cautious and consider selecting the ETFs which gives the better liquidity. Like in the current scenario, the international ETF doesn't have much liquidity because of the RBI restrictions on foreign investment. And thus, you will see that the price of international ETFs are quite high and they fluctuate much. So that's why if you have to invest or if you have to sell a large quantity of international ETF, you will not find a buyer or seller, or even if you find it, you have to lower your price or increase your price, and that can decrease your profit or increase your cost of buying. The second reason is tracking error. We buy ETF thinking that we are buying the ETF of the index, but with tracking error you don't get the actual result. Let's first understand what exactly is the tracking error. Tracking error is the measure which tells you how much is the deviation between ETF performance and the benchmark index. The lesser the tracking error, the more better the ETF is, because ETF is tracking your favorite index and it is not deviating much. So that means the ETF which have higher tracking error, it indicates that your ETF is not able to follow the benchmark correctly. This is the case for most of the ETFs out there. So it's very important for us to filter out the ETF which has the lesser tracking error for better performance. Next is market risk. The ETFs are highly volatile and thus it increases the risk for investors. If I talk about the international ETF, you can see that sometimes the prices goes up and down like crazy because of the volatility, and thus it increases the risk for individuals. Also, when you are investing in the ETF, it's better to invest in that ETF which has the highest volume. And thus, when more and more people are actually buying and selling that ETF, it decreases the market risk. because it reduces the volatility. So, I'm not saying that all the ETFs have higher volatility. We have to find the ETF which has less volatility and more volume. Then only you will find some stability of the ETF price. Then next is sector concentration. When we invest, we should diversify our investment such that if one sector is not performing well, the other sector can increase our returns. But if you are investing in a sector specific ETF, it leads to a concentrated exposure to a particular sector. And thus, if these sectors underperforms, it can hamper your portfolio. Some of the sectors are like, if I talk about some of the sectors which are banking, technology, or pharmaceuticals. If your chosen ETF strategy is to invest in a sector, and if the sector underperforms, then it can hamper overall portfolio returns. So ETFs will be a good investment if you can balance the ETF with diversified approach. If you are investing only in Nifty 50, it's fine. But again, you might not get a very good returns. That is our next reason. Reduced returns. ETFs mainly gives lower returns than the individual stock. For example, in last 1 year, a lot of stock has given us 50% returns, whereas Nifty 50 ETF actually gave us only 25% returns. So, ETF investment is a bad idea for returns because during bullish market, individual stocks or even actively managed strategies might outperform by huge margin. So, ETF investing is a bad investment for people who are seeking higher returns. So, these are some of the reasons why ETF might not be a good investment for you. There are some of the reasons why ETF are not good investment, but if you can mitigate the risk by going with a diversified approach, as well as if you are contained with lower returns, then ETF investing might be okay. Otherwise, you might need to look out for other strategies in place of ETF. If I talk about my ETF strategy, I use Mahesh Chandra Kaushik's etfkidukan strategy, which is a passive income strategy which gives regular returns. And as you can see, I have included that in this description. In the description of this video, I have got 16% returns in the last 1 year, whereas some of the stocks has given me 50% returns. But the only advantage of that strategy is that it gives me regular returns. Thank you for watching. Please like, subscribe and share the video if you have liked it. Thank you.